I am Aileen Abad. I will be presenting about efficient market theory. Stock prices are determined by a number of factors such as fundamental factors, technical factors, and psychological factors. The behavior of stock prices is studied with the help of different methods such as fundamental analysis and technical analysis. Fundamental analysis seeks to evaluate the intrinsic value of securities by studying the fundamental factors affecting the performance of the economy, industry, and companies. Technical analysis believes that the past behavior of stock prices gives an indication of the future behavior. It tries to study the patterns in stock price behavior through charts and predict the future movements in prices. There is third theory on stock price behavior, which questions the assumptions of technical analysis. The basic assumption in technical analysis is that stock buying movement is quite orderly and not random. From the result of several empirical studies on stock price movements, the advocates of the new theory assert that share price movements are random. The new theory came to be known as random walk theory because of its principal contention that share price movements represent a random walk rather than an orderly movement. Let's talk about random walk theory. Stock price behavior is explained by the theory in the following manner. A change occurs in the price of stock only because of certain changes in the economy, industry, or company. Information about these changes alters the stock prices immediately and the stock moves to a new level, either upward or downwards, depending on the new information. The central idea behind the random walk theory is that the randomness of stock prices renders attempt to find price patterns or take advantage of new information futile. In particular, the theory claims that day-to-day stock prices are independent to each other, meaning that momentum does not generally exist and calculations of past earnings growth does not predict the future growth. The basic premise in random walk theory is that the information on changes in the economy, industry, and company performance is immediately and fully spread so that all investors have full knowledge of the information. Therefore, the price of a security 2 days ago can in no way help in speculating the price 2 days later. The price of each day is independent. It may be unchanged, higher or lower from the previous price, but that depends on the new pieces of information being received each day. Another is the efficient market hypothesis. This hypothesis states that share prices reflect all information and consistent alpha generation is impossible. Stocks always trade at their fair value on exchange, making it impossible for investors to purchase undervalued stocks or sell stocks or for inflated prices. Therefore, it should be impossible to outperform the overall market through expert stock selection or market timing, and the only way an investor can obtain higher returns is by purchasing riskier investments. The efficient market model is actually concerned with the speed with which information is incorporated into security prices. The technicians believe that past price sequence contains information about the future price movements because they believe that information is slowly incorporated in security prices. This gives technicians an opportunity to earn excess returns by studying the patterns in price movements and trading accordingly. The efficient market theory holds the view that in an efficient market, new information is processed and evaluated as it arrives, and prices instantaneously adjust to new and correct levels. Consequently, an investor cannot consistently earn excess returns by undertaking fundamental analysis or technical analysis. The efficient market hypothesis states that the market cannot be beaten because it incorporates all important information into current share prices, so stocks trade at the fairest value. Though the efficient market hypothesis theorizes the market is generally efficient, the theory is offered in 3 different versions: the weak form, semi-strong, and the strong form. The weak form suggests today's stock prices reflect all the data of past prices and that no information or no form of technical analysis can aid investors. Next is the semi-strong form, which submits that because public information is part of stock's current price, investors cannot utilize either technical or fundamental analysis. The information not available to the public can help investors. While the strong form versions states that all information, both public and private, is fully reflected in security prices and whether any type of investor is able to earn excess return. Empirical test of weak form efficiency. The weak form of the efficient market hypothesis says that the current prices of stocks already fully reflect all the information that is contained in the historical sequence of prices. The new price movements are completely random. They are produced by new pieces of information and are not related or dependent on past price movements. Therefore, there is no benefit in studying the historical sequence of prices to gain abnormal returns from trading in securities. This implies the technical analysis, which relies on charts of price movements in the past, is not a meaningful analysis for making abnormal trading profits. The weak form of the efficient market hypothesis is thus a direct repudiation of technical analysis. That's all for my report. Let's listen to the next reporter. Thank you.
Good morning, sir. Our next topic is all about serial correlation test. Serial correlation is the relationship between a variable and log version of itself over various time intervals. Repeating patterns often show serial correlation when the level of a variable affects its future level. In finance, this correlation is used by technical analysts to determine how well the past price of a security predicts the future. Since the weak form efficient market hypothesis or EMH postulates independence between successive price changes, such independence or randomness in stock price movements can be related by calculating the correlation between the price changes in one period and changes for the same stock in another period. This correlation coefficient can take on a value ranging from -1 to +1. A positive number indicates a direct relation. A negative value implies an inverse relationship, and a close to zero implies no relationship. Thus, if correlation coefficient is close to zero, the price changes can be considered to be serially independent. Almost all large financial institutions now have quant analysts, known as quants on staff. These financial trading analysts use technical analysis and other statistical inferences to analyze and predict the stock market. These modelers attempt to identify the structure of the correlation to improve forecasts and the potential profitability of a strategy. In addition, identifying correlation structure improves the realism of any simulated time series based on the model. Accurate simulations reduce the risk of investment strategies. Quants are integral to the success of many of these financial institutions since they provide market models that institution then uses as the basis for its investment strategy. Serial correlation among these quant is determined using the Durbin-Watson test. The correlation can be either positive or negative. Stock price displaying positive serial correlation has a positive pattern. A security that has a negative serial correlation has a negative influence of itself over time. Second one is run test. A run test is a statistical procedure that examines whether a string of data is occurring randomly from a specific distribution. The run test analyzes the occurrence of similar events that are separated by events that are different. In investing, a run test can be important for investors to determine if the data set they are using is randomly generated or if it is impacted by an underlying variable. Traders who focus on technical analysis can use a run test to help analyze the price action of a security. The run test is another test used to test the randomness in stock price movements. In this test, the absolute values of price changes are ignored. Only direction of change is considered. An increase in price is represented by plus signs. The decrease is represented by negative signs. When there is no change in price, it is represented by 0. A consecutive consequence of the same sign is considered as a run. Next is all about filter tests. If a stock price changes are random in nature, it would be extremely difficult to develop successful mechanical trading systems. Filter tests have been developed as direct tests of a specific mechanical trading strategies to examine their validity and usefulness. It is often believed that as long as no new information enters the market, the price fluctuates randomly within two barriers, one lower and other higher around the fair price. When new information comes into the market, a new equilibrium price will be determined. If the new is favorable, then the price should be moved up to a new equilibrium above the old price. Investors will know that this is occurring when the price breaks through the old barrier. If investors purchase at this point, they will benefit the price increase to the new equilibrium level. Likewise, if the news received is unfavorable, the price of the stock will be declined to a lower equilibrium level. If investors sell the stock as it breaks the lower barrier, they will avoid much of the decline. Technicians set up trading strategies based on such patterns to earn excess returns. The strategy is called a filter rule. A filter rule is a trading strategy in which a technical analyst set rules when to buy and sell investments based on percentage changes from prior prices. The filter rule is generally based on a price momentum or the belief that rising prices tend to continue to rise and falling prices tend to continue to fall. A certain percentage rise triggers a buy, while a certain percentage fall triggers a sell. Although a trader could decide to do the opposite as well. It is a subjective strategy as the percentage level selected is based on the analyst's interpretation of a stock price history. In short, a filter rule is a trading strategy based on predetermined price changes, typically quantified as a percentage. The trader determines the price change they want to use based on analyzing charts and determining which percentage works best for what. The last one is all about distribution pattern. It is a rule of statistics that the distribution of random occurrences will conform to a normal distribution. Then, if prices are random, their distribution should also be approximately normal. Therefore, the distribution of price changes can be studied to test the randomness or otherwise of stock price movements. Distribution is one of the four elements of marketing mix. Distribution is the process of making a product or service available for the consumer or the business user who needs it. This can be done directly by the procedure or service provider or using indirect channels with distributors or intermediaries. There are three approaches to distribution. First, mass distribution. The producer's products are stocked in the majority of outlets. This strategy is common for mass-produced products such as basic supplies, snack foods, magazines, and soft drinks beverages. Second one, selective distribution. The procedure relies on a few intermediaries to carry their product. This strategy is commonly observed for more specialized goods that are carried through specialist dealers, for example, brands of craft tools or large appliances. The third one, exclusive distribution. The procedure select only few intermediaries. Exclusive distribution occurs where the seller agrees to allow a single retailer the right to sell the manufacturer's products. This strategy is typically of luxury good retailers such as Gucci. That's all. Thank you.
So the next topic was be the empirical test of semi-strong form efficiency. So what is empirical test of semi-strong form efficiency? The semi-strong form of the efficiency market hypothesis says that the current prices of stocks not reflect all informational content of historical prices, but also reflect all publicly available information about the company being studied. So there are examples of publicly information that are available. These are the following. First is the corporate annual report. Number 2 is the company announcement. 3. Press release. 4. Announcement for forthcoming dividends. And lastly, the stock split and etc. So here, we can say that there is a enormous amount of variety of public information. Semi-strong form tests have been formed with respect to many different types of information. Much of the methodology used in semi-strong form tests has been introduced by Fama, Fisher, Jensen, and Droll. The general methodology followed in this study has been to take an economic event and measure its impact on this share price. So number one impact is, the impact is measured by taking the difference between the actual return and expected return on a security. And number two, the expected return on security in general estimated by using the market model or single index model suggested by William Sharp. There is a model that we can use in order to estimate expected return. So this is the formula. Ri is equal to Ai plus BIRM plus EI. And then wherein Ri is equal to the return on security, RM is equal to the return on a market index, and AI and BI is constant, and EI is equal to the random error. So this analysis is also known as the residual analysis. The positive difference between the actual return and expected return represent the excess return earned on a security. If the excess return is close to zero, it implies that the price reaction following the public announcement of information is immediately and price adjusts to a new level almost immediately. Thus, the lack of excess return would validate and in the semi-strong form or the EMH. So the next topic was be the test of the strong form efficiency. So the strong form hypothesis represent the extreme case of a market efficiency. The strong form of the efficiency market hypothesis maintains that the current security prices reflect all information, both publicly available information as well as private or inside information. This implies the information, whether public or inside, can be used to earn superior returns consistently. So, the strong form efficiency tests involve two types of tests. So, number one, or the first type of test, is the attempt to find whether those who have access to inside information have been able to utilize profitable such as inside information to earn excess return. And the second type of test is the examine the performance of mutual funds and the recommendation of investment analysis to see if these have succeed in achieve superior returns with the use of private information generated by them. Let's see the difference between EMH versus the fundamentals and technical analysis. So, there are three broad theories concerning stock movements. These are the fundamental analysis. Number two is the technical analysis. And number three is the efficient market hypothesis. Okay, first, let's talk about the fundamental analysis. Fundamental analysis believe that by analyzing key economic and financial variables, they can estimate and the intrinsic worth of security and then determine what investment action to take. And then fundamental analysis seek to identify underpriced securities and overpriced securities. Their investment strategy consists in buying underpriced securities and selling overpriced securities, thereby earning superior return. So, number two, the technical analysis. Technical analysis maintains that fundamental analysis is unnecessary, and he believes that history repeats itself. And lastly, he tries to predict future movements and share practices by studying the historical patterns and share price movement. And then the last one, we have the efficient market hypothesis. The efficient market hypothesis is expressed in three forms. So, the weak form of EMH directly contradicts technical analysis by maintaining the past prices and past price changes cannot use to forecast future price changes because successive price changes are independent for or of each other. So the semi-strong form of EMH contradicts fundamentals analysis or fundamental analysis to some extent by claiming that the market is efficient in the dissemination and processing of information and hence publicly available information cannot be used consistently to earn superior investment return. So, here we go. We have the comparative market hypothesis. So, what is comparative market hypothesis? The efficient market hypothesis, or the EMH, alternatively known as the efficient market theory, is a hypothesis that states that share prices reflect all information and consist alpha generation is impossible. According to the EMH, stock always trade at their fair value on exchange, making it impossible for investor to purchase undervalued stock or sell stock for inflated prices. Therefore, it should be impossible to outperform the overall market through expert stock selection or market timing. And the only way an investor can obtain higher return is by purchasing a risk investment. In reality, most markets do display some level of inefficiencies, and in extreme case, in inefficiency market can be an example of market failure. The efficient market hypothesis, or the EMH, holds that in an efficiently working market, asset prices always accurately reflect the asset's true value. For example, All publicly available information about a stock should be fully reflected in its current market price. With an inefficient market, in contrast, all the public available information is not reflected in the prices or in the price, suggesting that the bargains are available or that price could be overvalued.